G'day, I'm Nic Earner. I'm the Managing Director and CEO of Alkane Resources, ASX and TSX listed. We've recently merged with Mandalay Resources, now just Alkane Resources, and this financial year, which runs for us from July through to next June, we're going to do between 160 and 175,000 ounces of gold equivalent. Looking forward to talking to you, mate.
Yeah, well, glad to have you here. We're in Beaver Creek, Colorado, in America.
Fantastic. Yeah.
What are you hoping to get out of this session? Lots of meetings, I assume.
Yeah, lots of meetings. I've probably got 40 odd meetings here at Beaver Creek, and then another 20 something Denver Gold in Colorado Springs next week. So, look, I think this is one of the best places for the smaller end of town. It's funny, you know, if you're under $1 billion US, you're micro cap in the United States. But it's one of the, for people that are under a few billion US, it's one of the best places to come. A hell of a lot of funds here, a hell of a lot of investors, a lot of other development stories if you're looking at, you know, corporate growth opportunities around the place. And really, it's one of the best places to meet investor groups in one place across these two conferences that you can get in North America outside of, say, PDAC or BMO.
Yeah, so I always view this session as the kind of slightly smaller funds, and next week is the bigger, not just the bigger funds, but also the
bigger companies,
business
bigger funds,
groups, as you say, and maybe we'll talk a little bit about M&A out there as part of this conversation. But right, so right now we're in a kind of execution phase from this merger, and trying to integrate not just the assets, but the people as well. Yeah,
that's right. I mean, we both, you know, when you and I caught up with Fraser, and you've caught up with Fraser since, you know, we both have pretty distributed, you know, management structures and styles. But of course, there are just how do people work, how do people like to communicate, how does the board like to interact. So we're doing all of those things. We've just gone through our budgeting cycle. And so for Costerfield and Björkdal, our assets in Victoria and Sweden that were Mandalay assets, they typically ran a calendar budget year, whereas we have run a fiscal budget year from July to June. So just changing those style of things. Yeah. Looking at capital allocation, we haven't gone gangbusters on it, but certainly looking at capital allocation within the group and making some of those early decisions. Yeah. So yeah, all of that sort of thing is underway. Yes.
But also the reporting side of things. Obviously, you just issued guidance, increased guidance, and I want to talk about how that kind of breaks down in a second, but how Mandalay reported versus you reported, was there much difference, certainly in terms of, you know, the variables which can kind of change the valuations?
Similar. So there's internal reporting and external reporting. Sort of put internal reporting to one side. External reporting, the biggest differences are just the exchanges, TSX versus ASX, and just the different requirements and timings of each one, and the typical focus that people have. So, for instance, earnings is a really big thing, or a bigger thing on the TSX, whereas typically we report just pure cash flow on the ASX. And so, just making sure that we, you know, communicate both of those things well has been difficult. So, even our guidance announcement is a little more complex than normal. You know, we've got ounces, so that's fine, and then you've got Aussie dollars, and then you've got US dollars, and then you've got the fact that we actually merged on the 5th of August. So where does this first month go? Yeah. You know, I took 160, 175,000 ounces, but that includes, you know, a bit over 5,000 ounces coming from the first month of Mandalay. So, you know, the way that we will account for that needs to be taken part of. So all of those things are occurring, but we think we've got some very good assistance certainly in Toronto to do that well. So yeah,
and obviously sitting with a bunch of North American investors now on the register, which is great. They'll be used to the reporting in one way. So I'm thinking things like 43101 compliant type reports versus JORC, which can be in the earlier stage a little bit more opaque. You don't need to put so much information in. So how do you kind of get that balance right?
Well, we're lucky in that as part of the merger we had 43101s for sort of everything, right? So to a North American investor, things will seem very, very similar. Okay. Probably the timing will be a little bit earlier in the sequence. So if you think of a quarter end, in Australia, quarter ends end of September, we report that by the end of October. In the TSX, you report that by mid-November, but you have the MD&A, right? And so people, which has more fulsome information in it. So what we'll end up doing is having the more fulsome information in the October, and then making sure we have the extra TSX compliance of a bit later in November. So similar but different, yes.
So similar but different, but I guess each, I'm talking about your Aussie part of your register and the North American part of your register, are going to get new data to look at, but generally you've made a decision internally to standardize.
Yeah. Right, as much as possible, because you're trying to reduce rework, of course.
Yeah.
And the thing is, most investors, they really only care about what's your profit, what's your outlook over the years ahead,
and what's next.
What's next? Where's potential growth? Exactly, the classic.
Well, let's take a look at that. Let's take a look at the guidance, right? Because I think a much misunderstood part of the ops side of business is sometimes you have to work, all the time you have to work very hard just to stand still, let alone tell the growth story. So let's take what we know today. In terms of the growth, the guidance, you're upgrading by what as a percentage?
Well, so last year, pretend the whole group, all three mines were together last year. We would have done 161,000 equivalent ounces. Right. So this year we're intending to do more than that. So the bottom end of our guidance is 160,000 ounces, and the top end is 175.
Okay.
So not a massive leap forward. We obviously internally, people will see within that the amount we're spending on sustaining capex and growth capex. We want to position ourselves to move higher, 180 and beyond in the following year. So that's part of our capital allocation. But yeah, you're right, we run very hard. Like if you think about, let's say you have a mine doing 100,000 ounces, as an example, and you have a grade variation of 10%, that's 90 to 110,000 ounces. And to have a grade variation of 10% within a gold mine, particularly an orogenic gold mine, is not at all unusual. That's very, very normal, and you can see that in the way, when you dive into the 43101s and the JORCs and geostatistics and all that sort of good stuff, right? So putting guidance, there are swings and roundabouts at each operation.
So how do you manage that? How do you set stuff aside for a rainy day where you can sort of top
up?
Well,
you don't really. You would need things to go on the lower end of expectation at all three mines to fall out of the bottom end of your guidance. But it's fair to say, we rely on running our operations 24/7, nearly every day of the year. There are nuances in each jurisdiction to that. And we rely on people being productive as the industry or more productive in that period of time in order to meet our guidance, as does every operation. There's nothing I'm saying that's unusual. Yeah.
No, it's not unusual, but there's kind of blended risk that you guys have to kind of factor into your ops that you're planning, right? And feedback systems and measuring, all that kind of good stuff. Because the punitive nature of the downside risk means that you don't want to put yourself in a position where that may happen. And that's why I'm wondering if there's any kind of risk mitigation strategies on upside. And it's like, if we produce it, let's get it out there. But on the upside, the reward is not as much as the downside.
Yeah. I mean, you're right. People tend to get, and particularly in these sort of, I'll call it buoyant periods, people tend to get a lot more hammered for missing guidance than they do for outperforming. Yeah. Right, in the reverse direction in terms of the upside. Yeah. So we just plan as per normal, and this is what we intend to do, right? So we don't give ourselves a massive risk margin, if that makes sense. What we do is we look at financial instruments, or we look at operational risk mitigation things, which is alternate mining areas that you make sure that you've got development to, your stockpiling levels, your maintenance strategies, all the things behind it that make us confident in reaching an objective, leaving just major unexpected things left to
Right.
pull you to the
Because
downside.
I've seen it a lot. A lot of the big producers have come on here and said, well, yeah, actually the ounces are down, but the dollars are up, the margins up. But that's something out of their control. Do you know what I mean?
Totally,
The price of gold and the margins being created have got people out of a big hole. So that's why I come back to the fact that producing consistently high number of ounces, it's hard. It's really, really hard. So to counter that, there's a few things that you've got in your back pocket, which is obviously exploration, acquisition,
Yeah.
right? Or, getting lucky. So.
Yeah. But you're absolutely correct. The fundamental thing that people want to see in a producer is the capacity to predict what you're going to do and then go and do it. And in Alkane, we have a strong track record of that. We've only ever missed our guidance once. And then the bottom end of the guidance was 60 and we did 58.5. And that's the only time in 14 years or whatever it is now of production that we've missed that. And and obviously we've worked hard in order to enable that. But I completely agree. The fact that the gold price is rising is fantastic, mostly because it creates other opportunities that you otherwise wouldn't access. So what I mean by that is every ore body has, say in our case you're doing lateral development, there may be mineralisation that at a different price you would not have bothered to get at the end. Whereas now you're getting it, the margins might be the same, as what you were previously intending to get, but purely because the price has risen, but you would have discarded them at a lower price.
Yeah.
And that's fantastic for shareholders. It's preserving the resource.
Yeah.
While still generating close to the amount of cash you're going to generate anyway. So when I say close to, the reason you haven't got it is because it has been lower grade or higher cost to get there. And so that's still true, the lower grade or the higher cost, but the margin has risen. Yeah, so it's a very, very interesting period and been quite dynamic. If you think of the life of mine plans and areas that any mine was planning to access 2 years ago, Aussie gold was close to $3,000 an ounce, and now it's approaching 5.5. It's between 5 and 5.5, depending on the day.
Yeah.
Right. That's a massive difference. Obviously, costs have risen through that. It's been a high inflation period between that.
It changes
relatively.
And the mine planning changes.
Yeah. So mine planning completely changes. Yeah.
So I think so. You stay in certain places for longer, which is all good for in terms, like you say, for the reserve numbers and so forth. With regards to I guess the other thing in your factor is the fact that multi-jurisdictional portfolio approach really helps, and I guess multi-commodity as well.
Yeah. Okay. Yeah. I mean, it's funny. I do get asked quite a lot about antimony, all right? But it is only 6-7% of our revenue. Yeah. But because it's a critical mineral and because we're one of the larger Western producers or the largest, there's a lot of talk about it. But if we think about it, right, in a concentrate shipment that we send, and people say, oh wow, let's say the price of antimony doubles. So, but it's only half the value of that concentrate shipment, which is not a long way from all the gold coming out of Costerfield. Yeah. When the gold moves by just a couple $100, it completely wipes out antimony doubling for that site and that entity. So but we do have that commodity and all the interest that comes with that and the opportunity that comes with that, because there are other areas of the ore body that are higher in antimony, and so every % margin we chase, of course. And then multi-jurisdiction, absolutely. Like, it's very interesting, you have people come and talk to you who have things within Scandinavia. I think people are re-looking at that northern Norway, the whole of Sweden, Western Finland, in a new light in the precious metals, mostly because things that, probably people weren't bothering to take the permitting or investment risk on just because of the time value of that are going back and reconsidering those. And happily we're a producer in that area and have been a producer for a couple of decades in that space. So
It helps.
It helps.
If you've been there a while, you've gone through
helps.
the hoops
Yeah.
and the jumps, and you're established, and you've got the relationships.
Yeah, and you've got a.
It adds up. It adds up.
You've got a team of professionals already established doing their thing. Yeah.
Well, let's look at the next bit of the equation, which kind of moves you through this kind of not just next year's guidance, but into the future, which is you're building up, you're sorting out your balance sheet.
Yes,
tidy.
we've done that. We've repaid the debt with Macquarie, so we're now ostensibly debt free. The reason I say ostensibly is because we still maintain equipment finance. So it's just a method of.
No, but the Macquarie thing, I think, in years gone by, I can think of one very good example of the last couple of years. That the Macquarie debt on their books was a killer for them. So you want to achieve the right level of debt and comfort and cash flow and so forth. So I think these are little things that people kind of forget to look at, but they do look at the cash it gives you to go and do some exploration to drive that growth profile. Because at the end of the day, as I joked at the beginning, well done, you've done the merger. So what next?
And absolutely, and we've chuckled about that before. So. We are very, very well positioned for growth. So first we look internally. So at Tomingley we have growth capital circa 50 million Australian dollars this year. The vast majority of that is going into moving a highway to bring open cuts online. Open cuts, of course, brings more ounces, into the potential accessible, but they're cheaper ounces relatively. But not only that, it is sort of like having another mine. If we talk in terms of risk mitigation, you just have another source that you can go to your balance in terms of different things. So that's where that money's going. And we're spending a few $1 million there in exploration, but mostly because we have quite a good vision and picture for the next 7-8 years there. Yeah. Where we're spending a lot of money is at Costerfield. So we're spending the better part of $25 million drilling there in this coming financial year. I'm assuming that the things we think will be successful continue to be successful in saying that number. That is to establish a new ore source to the west of us that we would then make a development decision on later this year. We're embarking on that permitting process. Yeah. That should extend the mine life by several years more, all things going smoothly. It's 100,000 plus ounces and climbing, higher antimony grades, which is always interesting. But as well as that, we're looking very deep under that mine, because we know from that region that the vertical extents are quite remarkable and the intercepts are quite remarkable. And the intercepts that we get there, we can get, 2 metres at 2 ounces and stuff like that. It's very, very high grade mine. So that's where that effort is going. It does 140,000 tonnes a year. We look at the capacity to expand that, but the first thing we want to do is really ensure the resource base is set up. But, it will do sort of somewhere in that 45,000 to 50,000 ounce range this year, but we would like to keep that permanently above 50,000 ounces equivalent, right? So that's now at Björkdal. We do have $7-8 million going out in exploration, which is still quite substantial in the region. Particularly, we have a deposit called Storheden, which is about 350 metres off the existing structure. We've got a small open cut that we're working through the permitting on, but the big thing we're doing there is putting a lot of money into sustaining capital for mine development, because the big thing for Björkdal is to have as many tonnes mined from that underground as possible. We have a 1.4 million tonne per annum capacity mill, and we typically mine at 1 million tonnes a year and then supplement with lower grade surface stockpiles, which we have substantial quantities of. But again, the guidance of that, it'll be in the lower 40s this year, 40 to 45,000 ounces there or thereabouts. We very much want to see that above 50,000 ounces as well. And when you put those together with the work occurring at Tomingley, that puts us, firmly plus 180,000 ounces on a yearly basis. So that's sort of step one. And you'd expect us to do that. That's just, I'll call it normal business as usual mining. Difficult, but business as usual. And then we have, what is the next stage of growth for us? We've firmly stated, and nothing's changed from the board about that, would very much like to add another operation to the business. We are prepared to develop something. Right, and it all comes down to what's the best use of money to get that. And operating assets, it depends on why the operating asset's available for sale. Things can be subscale to a larger producer, but then it could be really fiercely contested, and people basically being asked to bank in the current gold price forever, part of the transaction. So there's those style of transactions, smaller assets coming out. There's things that we would develop ourselves. We as an organisation, as people, we have developed mines before, so we're comfortable and familiar with that. What we don't want to do is wander into some permitting vortex.
Yeah.
Right. If we were to develop something, we want to see that production occurring within 2027.
Okay, that's time frame. Okay,
Yeah.
interesting.
Yeah.
Okay.
So you want to be launching, and then it typically takes 12 to 18 months to bring a gold mine online, if it's known and approved, and in a jurisdiction where you can get people and equipment there reasonably quickly. The lead time for a mill's circa a year. So you'll build everything around and then put that in and then go.
Okay.
So, and the reason why I say that is, I think if you look at shareholders, investors in this market, which is shorter dated, and people are trying to say they're balancing, well, what's the true forward gold curve that I think that I'm going to value your stock on, versus a development time and development promise. If I had something absolutely certain that was going to be out in 2030, people would be like, well, how do I value that? What's the price going to be? But if it's 2027, people can say, okay, I've got to...
Yeah, it sounds like
Yeah.
It's a tough one.
Yeah, it's
my crystal ball is fogging up at the moment, because I wonder how long this can sustain for. Can it sustain? Can it grow? Can it go further? What your view of the world economy and the dollar, etc. All very important. But let's stick again back to what we're in control of. And I do want to talk about M&A, because I think that's it's harder than people realise. It's more competitive than people realise, especially at this moment. I think we've talked in the past about this. There's a kind of golden period where there's less competition, overpaying, and you're not competing against people who it's worth more to them than it is to you, sort of thing. But return on invested capital, we talk about, very casually, nice place to be, 25 million on a drill program. When you look at that, you've got to say to yourself, and you gave some clues about the type of ounces that's got to return for you, because you don't want to be continually banging out 25 million exploration capital, for the next 5 years. It's like, no. What are the moving parts? So
let's say with $25 million you can define 100,000 ounces as an example, right? We would obviously hope to define more. 100,000 ounces at Costerfield, 2 years production. Each year, the guidance this year, that's circa $2,500 Australian. Yeah. So your margin there, that's all-in sustaining cost. All-in cost is a little bit higher than that, but we run for all-in sustaining cost. The margin on that, $2,500, $3,000. Okay. Call that 2.5, so 250 million on the 100,000. Now, clearly, money from that will be eroded by the other things that aren't in an all-in sustaining cost, and it's because it will reinvest for its own future going forward. Yep. But even if we take that 250 and turn that down into 150 million bucks, you're hoping to, with near mine exploration, effectively put 20, 30 million bucks in and define a future $150 million or more, right? And the returns on that are, of course, outsized as a percentage. Yeah.
So which is the organic component?
Yes.
Across all three.
Yeah. So
right?
inorganic, by far and away, the best value that can occur for M&A is like Mandalay and Alkane coming together. Similar price to NAV. Yeah. Similar margin businesses, similar overhead businesses, where you're putting the registers together at a nominal rate. Now that you can, depending on how stuff, you could make small wins and losses, but they just vanish in the noise. So absolutely, they are by far and away the best transactions to do. But when you approach a developer, let's say you approach a developer who wants to bring a mine in production, and it's going to be a 70,000 ounce a year mine, and it's going to go for 7 years. So I'll call it a threshold development. That person may have aspirations of saying, we think that we could therefore have a net present value as we look at it on the thing today. Our net present value for that is $800 million, therefore we should be worth $800 million, therefore you should pay us that and a premium for the thing. But that is, of course, a completely risk-free, adjusted, exactly, right? Yeah. And so, but their market cap might be $200 million. And so to to come together on a nil premium basis for those guys, they'd think, well, why would I bother if someone else would pay me a 50% premium on the stock? But when you start then getting, okay, well, I'm going to pay a 50% premium on this, but then I have to develop the project myself, and et cetera, et cetera, et cetera. You sort of think, well, the margin return on that is lower than other things. So there's a real balance there. So merger of equals is number one. Developer where you're willing to find a price point where you can share in the upside together is number two. An asset where they are just missing a capital chunk and can't pull it together without too much, and so you offer the least dilutionary solution, right, with the capacity for
some exposure to the upside.
Some exposure to the upside.
Yeah.
But the main thing we're interested in is exposure and upside for Alkane shareholders.
Absolutely.
Yeah. So
we're
incredibly selfish about that.
Yeah.
Yeah.
As you should be. I'm just wondering, because I've seen quite a few companies having to change and adapt their business model entirely, given the last 3-4 years of lack of access to equity and cheap equity at that, and where they're saying, well, actually, we're going to create a nearer term revenue production profile.
Yeah.
Right. Sometimes maybe realistic and sometimes very unrealistic, but they've been rewarded a little bit nevertheless. But they're still mostly in a position, there are some notable exceptions, where they still haven't got the equity access in the sorts of sizable chunks that a producer might have. Are you seeing a slightly different profile of M&A potential over the last couple of years?
Yeah, absolutely. I think access to equity has increased now. If people have, a credible launch plan, I think that's absolutely increased, and you can see that. You can see people's stock prices starting to re-rate in anticipation of that, even knowing an equity raising will come. Whereas before it would have stayed suppressed for a really long time. One of the interesting phenomenons about that rising stock price is it almost completely locks them into being a single mine producer.
Yep. Yeah.
Right, and because the odds of someone buying them out will be low, just because the purchase price is great. For us, or anyone else in our position, the potential best entry point is to see them come into production, de-risk their business, and then deal with the harsh reality of being a single mine producer, which is that this totally open blue sky upside no longer exists. People want to talk about, oh, here's your reserve, here's your margin, what does that look like? So on and so forth, right? And so in general, people that have come into production and have found themselves, like Alkane was, like Mandalay was, held in a particular valuation position, they're our sweetest spot. Yeah. But they are the hardest to find.
But at that point, you're not really competing against mid-tiers or majors, clearly.
Yeah.
It's a different pool that you're competing against, but nevertheless an ambitious, aggressive pool, and sometimes desperate pool, saying, well, if we can jam these guys together, we all might survive. We all got a chance of monetizing this, because whereas a single asset entity does not. And I've got a few examples on the table. So we work with some of them.
Yeah, look, and people have had people have had both success and failure doing that, right? And happily we're part of that success. We're in the firmly in the ASX 300 now, and things are looking solid. But so to be more specific for people, we would very much we are already looking at what is our next leg of growth, because we have different people working on that to integrating, and we want to be in a position to act on that, within the next 12 months. In an ideal world.
And is speed important? Is that having a cash reserve to be able to do that, or is it more about the structure?
I think speed is important, because, and I'm not talking about, just driving blindly as fast as you can, but speed is important because it's incredibly difficult to do any transaction, because you need two parties to be aligned with a common view on value. Yeah. And so if you're not out there actively looking the entire time, you will simply miss that opportunity.
Well, I've also got an example of it. It was a very angry Aussie CEO who spent 10 months doing diligence on a project, only to be gazumped and just as they were closing, because it had just taken too long to negotiate the actual terms because they were not, as you say, similar-ish. It was slightly out of whack, and that causes some tension and maybe delaying taxes. And I've seen it from banking days that you think you've got a deal done and then it doesn't happen. So there's all
because
of that.
I think as we've discussed before, not on camera, it's incredibly easy to think of what a deal could be.
Yeah.
The difficulty is how do you get that deal done?
Yeah.
How do you convince different shareholders? How do you get there? Yeah, all of those sort of things. And so if you're not acting on that all the time, and if you're not acting on that with alacrity, and if you're not prepared to both compromise and take advantage of situations, then you're going to miss out on opportunities. It's as simple as that.
Yeah, I think it's an interesting time for companies like yourself. Like I say, you're taking care of business with the kind of maintaining the ops and driving those ounces, and organic to come, and with an eye to the future. You've shown you can do M&A. You show you can.
And we have a board set up for that as well, right? So,
which is the difference.
Yeah.
Young man, thank you very much.
Thanks,
Enjoy
mate.
the rest of the week here. You've got a fair few meetings, right?
Well, so do you guys.
Yeah, one or two.
But everybody here has a lot of meetings. But it's as you said, a great space to do business for 2 weeks. Yeah,
It's fantastic. Thank you.
Thanks, mate.